Welcome back to our channel, Stock Market Analyst. Today, we're diving into the basics of fundamental analysis of stocks. By the end of this video, you'll have a clear understanding of what fundamental analysis is, why it's important, and how to use it to make informed investment decisions. What is fundamental analysis? Fundamental analysis is a method used by investors to evaluate a company's financial health and intrinsic value. It involves analyzing financial statements, management, industry conditions, and other factors to determine whether a stock is undervalued or overvalued. The goal is to make informed investment decisions based on a company's fundamentals. Key components of fundamental analysis. Let's break down the key components of fundamental analysis. 1. Financial statements. These include the income statement, balance sheet, and cash flow statement. They provide insights into a company's revenue, expenses, assets, liabilities, and cash flow. 2. Earnings per share, EPS. This metric shows the portion of a company's profit allocated to each outstanding share of common stock. It's a key indicator of a company's profitability. 3. Price to earnings, P/E, ratio. This ratio compares a company's current share price to its earnings per share. It helps investors determine if a stock is overvalued or undervalued. 4. Return on equity, ROE. This metric measures a company's profitability by comparing net income to shareholders' equity. A higher ROE indicates a more efficient company. 5. Debt to equity ratio. This ratio compares a company's total debt to its shareholders' equity. It helps investors assess a company's financial leverage and risk. Analyzing financial statements. Let's take a closer look at the three main financial statements. 1. Income statement. This statement shows a company's revenue, expenses, and net income over a specific period. It helps investors understand how well a company is generating profit from its operations. 2. Balance sheet. This statement provides a snapshot of a company's assets, liabilities, and shareholders' equity at a specific point in time. It helps investors assess a company's financial stability and liquidity. 3. Cash flow statement. This statement shows the inflows and outflows of cash from operating, investing, and financing activities. It helps investors understand how well a company manages its cash flow. Understanding earnings per share, EPS. Earnings per share, EPS, is calculated by dividing a company's net income by the number of outstanding shares. For example, if a company has a net income of $1 million and 1 million outstanding shares, its EPS would be $1. A higher EPS indicates greater profitability and is often seen as a positive sign by investors. Price to earnings, P/E ratio. The price to earnings, P/E ratio is calculated by dividing a company's current share price by its earnings per share. For example, if a company's share price is $50 and its EPS is $5, its P/E ratio would be 10. A lower P/E ratio may indicate that a stock is undervalued, while a higher P/E ratio may suggest that a stock is overvalued. Return on equity, ROE. Return on equity, ROE, is calculated by dividing a company's net income by its shareholders' equity. For example, if a company has a net income of $500,000 and shareholders' equity of $2 million, its ROE would be 25%. A higher ROE indicates that a company is more efficient at generating profit from its equity. Debt to equity ratio. The debt to equity ratio is calculated by dividing a company's total debt by its shareholders' equity. For example, if a company has total debt of $1 million and shareholders' equity of $2 million, its debt to equity ratio would be 0.5. A lower ratio indicates less financial risk, while a higher ratio suggests higher leverage and potential risk. Real financial statements with annotations. Let's look at a practical example. Here's a financial statement of Apple Inc. Notice how we analyze the income statement to understand the company's profitability, the balance sheet to assess its financial stability, and the cash flow statement to evaluate its cash management. Revenue. Apple posted quarterly revenue of $94.9 billion, up 6% year-over-year. Apple's revenue growth of 6% year-over-year indicates strong performance and demand for its products and services. Earnings per share, EPS. EPS is a critical metric for investors as it shows the company's profitability on a per-share basis. Apple's EPS of 97 cents reflects its ability to generate profits for shareholders. Revenue. Apple posted quarterly revenue of $94.9 billion, up 6% year-over-year. Apple's revenue growth of 6% year-over-year indicates strong performance and demand for its products and services. Operating cash flow is a measure of the cash generated by the company's core business operations. Apple's operating cash flow of $27 billion demonstrates its strong cash-generating capabilities. To sum up, fundamental analysis involves evaluating a company's financial health and intrinsic value by analyzing financial statements and key metrics. By mastering these basics, you'll be better equipped to make informed investment decisions and identify undervalued or overvalued stocks. That's a wrap on our guide to fundamental analysis of stocks. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and share it with your friends. Have any questions or topics you'd like us to cover? Drop them in the comments below. Happy investing!